Hey guys, welcome back to day 18 of 365 days challenge. And yesterday we were about to learn this concept, like liquidity, stop and orders, USD strength versus weakness, new CPI NFP interest rate, global event, wars, uncertainty, correlation, gold, silver, DXY. We were about to learn like what happened. Like we already learned bunch of video about liquidity. We already know that liquidity sits at equal lows, equal highs, SMT, or some order block or some hidden liquidity place that we think that there may be liquidity. But for example, I just learned, like I will show you guys later, like people buy bunch of subscription for a DOM chart or liquidity chart or footprint chart, bunch of this kind of thing, because they want to, like, it works, like it basically shows you where the liquidity really lies. If it's lows, if it highs, where does liquidity lies. This kind of chart really helps you like identify where the liquidity lies. But like you have to pay huge like subscription, like 100 $200 for maybe for normal trader, as like for us, when we are not profitable, like we cannot buy this kind of subscription. So I got a free website where you can make account and you guys can basically, like, without depositing any money, you can use that kind of chart you can use to identify liquidity. And that's it, guys. Today, day 18. What moves price? Explanation. Core idea of today: price does not move randomly, it moves because of liquidity plus fundamentals. Okay, liquidity means stops and orders. Price target, liquidity stops, equal highs, equal lows. Target moves happen after liquidity is taken. Price moves where money is resting. Basically, liquidity is where big institution, for like bank institution, like this big player, they want to take big orders, and to fulfill their big orders, they always go to hunt these places where other people stop, or stop loss is there. They basically go there, and when it taps, when other people are out, they enter with big position, and it basically reverse the price into their direction. And later we're gonna learn USD strength versus weakness. Strong USD, gold goes down. Weak USD, gold goes up. Gold and USD move in opposite direction. 3. News, CPI, NFP, interest rate. High impact news create volatility. A price often takes liquidity first, then moves in real direction. News is catalyst, it's not random movement. For example, guys, I have like bunch of, like, when I was noob trader, when I didn't know anything. I'm still noob trader, but back in the days when I didn't know anything about trading, I entered, and basically I was in one normal trade, and this huge Chow USD candle came and it took everything, and basically seconds later it reversed and goes to direction where my take profit was. And that's when I found out that news can be so volatile that it can blow your account if you didn't put stop loss, or whatever can happen. So we have to be careful about when news is CPI, NFP, interest rate. Okay, and price often takes liquidity first, then moves in real direction. News is catalyst, not a random movement. Fourth, global events, war, uncertainty. For example, market fears, gold rise, and gold becomes safe haven. For example, throughout every history, maybe not in the medieval time, but gold has been always valuable thing, like valuable asset. Whenever there is war or whatever, gold is always safe haven asset, known as safe haven asset. But like sometimes market also crash because of this kind of moves, but Most of the time market goes off. Market stability, gold can drop. Bigger events, stronger moves. Fifth, correlation. Like we wanted to learn correlation because, like for example, gold and silver moves together. Gold USD moves opposite. Like whenever gold, like USD is weak, gold goes up. Whenever USD is strong, gold goes down. Use correlation for confirmation. Like we can use correlation for our advantage against the market. We can use, like, this basically, this whole, like, whole thing we're gonna learn is basically gonna make our fundamentals and knowledge about trading much more profound than it's already is. So it's, trading is always learning about new things and making yourself better. Like, it's the game where you, if you are not learning, you either gonna be weak or dumb. So guys, let's start. So here we are, guys. I will put this here. For example, market drivers master reference, USD strength, DXY. The US dollar, the market backbone. Every major asset is priced against it. The DXY, dollar index, measure USD strength against a basket of six major currency. When the dollar is strong, money flows into it and out of commodities and risk asset. When it weakens, capital rotates everywhere elsewhere into gold, emerging market, and commodity currency. For example, USD is strengthens when interest rate is rise, inflation cools, I mean CPI drops, strong jobs data, NFP, and global uncertainty spikes, and Fed turns hawkish. And when USD weakens, rate cut or paused, inflation runs hot, weak job data, risk appetite returns, Fed turn dovish. Impact on key instrument. Gold, for example. Gold falls when USD rise. Basically, US strength rise. URUSD falls when USD rise. GPB USD falls when USD rise. USD JPY right. I mean JPB USD falls when USD rise. USD JPY rises when USD rises. Dang. And Chow USD rises when USD fall. URUSD rises when USD falls. JPB USD rises when USD falls. USD JPY falls when USD falls. Every session open the DXY chart first. Before every session, guys, before every session, every kind of like major currency or commodities you are trading, before, always go and see, open the DXY chart first. Its direction tells you whether to be looking for longs or short on gold and forex pair before you even see a signal. For example, and let's go to news event. High impact economic news, a scheduled event that moves market with precision. CPI means consumer price index, measures how fast prices are rising across the economy. The Fed primary tool for rate decision, released monthly. That's mean basically CPI is released monthly, and it says here that, like, gold is strengthened when CPI drops. So if CPI news is low, gold goes up. If CPI is strong, maybe gold weakens. Let's see. CPI beats expectation. USD strength, gold drops, stock may fall. So basically, if CPI expectation is different than the expected thing, USD strength, gold drops, and stock may fall. If CPI is not known, not where the expectation is, USD weakens, gold rallies, red cut hopes rise. NFP non-farm payrolls report how many jobs were added to the US economy in a month, excluding farming, released first Friday of each month, one of the most volatile events of the calendar. For example, CPI is inflation and NFP is employment. And strong jobs number, there are huge jobs numbers like job were created, economic is healthy, no rate cut needs, USD up and gold down. If there are weak job number, economic slowing, rate cuts expected, USD down, gold up. FOMC interest rate decision, basically rates. The Federal Reserve meeting where they vote on interest rate happens 8 times per year. Market often move in anticipation weeks before the decision itself can reserve trend or accelerate them. Rate hike and how weeks tone. USD spikes, gold sells off, borrowing cost rises. Rate cut, Dobby stone. USD drops, gold surges, risk appetite increase. News events don't move in a straight line. They often sweep liquidity first, spiking in one direction to trigger stops, then reverse into the real move. Never trade the first candle on the news event. Wait for the sweep, then the confirmation. Like, guys, I swear to God, like this happens every time. Like there is this news, market goes up very fast, sweeps, and you think in your mind that market will go up. Okay, you think in your mind market will go up, and basically what market does, big red candle, and it's basically showing that it swept whole liquidity, whole the trader were sitting on it, basically swept all those liquidity and going down, took all the buyer also and going to real direction. Like that happens always. Like I know most of the people enter at the first candle, basically high risk high reward. So let's go to global events. Geopolitical macro and macro events, unscheduled shocks that override technical setups. When the world feels uncertain, institutional money rotates into safe haven asset instruments that hold value during crisis. Understanding this rotation lets you position early before the crowd reacts. Trigger: armed conflict or wars, banking financial crisis, political instability, pandemic or health crisis, sanction or trade war, sovereign debt default. For example, Chow USD Gold, the oldest safe haven, rises reliably during fear, has no counterparty risk, it cannot go bankrupt. USD US Treasuries, global reserve currency in crisis, dollar demand rises as countries and institutions rush to safety. JPY, a Swiss francs and Japanese yens also act as a safe haven, strengthened during global uncertainty. How to read the rotation? For example, conflict escalate, gold's up, a USD up plus oil supply risk. Crisis de-escalates. Gold down, risks asset up, and safe haven down. Bank crisis and recession fear. Gold up, JPY up, and equities down. Geopolitical event can override every technical level on your chart. Always check headline before entering a trade. A perfect setup at a liquidity zone means nothing if a missile was just fired somewhere. Like, guys, trading is not just knowing technical analysis, like some strategy. Like, it's not about this thing. The thing we are learning is so great. Like, we learned throughout our adventure, Trading in the Zone by Mark Douglas. He basically showed us how the human emotion and everything can work, you know. If we can control this emotion, we can achieve anything. Like, I don't know, I see most of the people, they think, oh, like if I know good strategy, risk to management, I can do anything. No, bro, you are dumb. You are dumb. Trading doesn't mean just knowing one to two things. You have to know whole market, how market moves, what happened, what market, like what strengthen its price, why it goes down, like news event, like why everything happens. You know, like we have to understand that. Like market is not just about strategy or liquidity zone, or no, that's useless. Like if you have that kind of knowledge, you are just noob. Okay, let's go. Correlation. Market correlation, how instrument moves in relation to each other. Correlation are confirmation tools. You are never looking at one chart, you are a reading system. When multiple instruments align with your trade idea, confidence rise. When they diverge, caution is warranted. Key correlation pairs. For example, Chow USD and DXY. DXY up, gold down. DXY down, gold up. This is the most reliable correlation in the market. Use DXY direction to confirm your gold bias before trade. Inverse, strong, positive, strong, inverse, very strong, positive, strong. Chow USD and silver, CHAG USD. Gold and silver move together. Silver is more volatile. It moves faster and further. If gold is bullish but silver is falling, treat it as a warning signal before entering. Basically, it means that both gold and silver moves together. When gold goes up, silver goes up. If the silver is falling, if the gold is bullish but silver is falling, treat it as a warning signal, like manipulation. Some manipulation can happen. Like if gold is bullish and silver is falling, see it as the silver is trying to manipulate some liquidity zone and it will go to the gold direction. Okay. URUSD DXY. URUSD is the largest component of the DXY basket, 57.6% weighted in. They are nearly mirror image. If DXY is breaking a high, expect URUSD to be breaking a low. USD JPY versus US bonds yield. When US Treasury yields rises, bond sells off. USD JPY tends to climb. Traders buy dollars to capture higher yield versus the near zero Japanese rate. Was the 10 years yield of as a leading indicator. The confirmation the confirmation workflow. DXY direction, gold silver align. Your USD confirm, enter with confidence. For example, if we want to take trade on gold, if we really want to take trade on gold, see DXY direction, how the gold dollar strength is, what the where the dollar is moving, and see if the gold and silver is aligned, like they are moving in the same direction. So that's how we can make a perfect entry with our setup, with our basis, with our fundamentals. Correlation are not perfect. They break during extreme event, but when correlation and technical and fundamental align in the same direction, this that is your highest probability trade setup. So there you have, guys. This is all the sauce that I'm dropping for you guys. Let's go read different PDF. Same news but different kind of way for you guys to understand. Okay, let's go. So guys, here we are. Masterclass liquidity where price is drawn. Master teacher says, think of liquidity like magnet. Price doesn't move randomly. It moves toward where the most money is waiting. For example, equal highs, liquidity above, stop hunt spike and market goes down. The analogy: imagine a crowded exist in a stadium. Everyone rushes to same door. Price is crowded, liquidity is the door. Okay? Key fact: big institution needs massive order field. They push price to where retail stops are clustered, then reverse. Key concept: equal highs, stop loss sits just above, price spikes up to grab them, equal lows, stop loss just sit below, price drops to grab them. Buy stop pending orders above highs add fuel to upward spike. Sell stop pending orders below low add fuel to downward drops. Test yourself. Why does price often spike above a key high before reversing down? Random market noise to grab liquidity. A is it quiz, yeah. Why does price often spike above a key high before reversing down? Yeah, to grab a stop loss sitting above high. Yeah, the institution needs liquidity to fill their large short position. They push price to up to grab buy stops and loss stop losses, then reverse hard. Let's go. Let's read next. USD. Basically, we read different kind of PDF, but I am reading different PDF so you guys can understand it. The US dollar is the world reserve currency. When it moves, everything priced in US moves opposite. USD up, gold down, USD down, and GBP USD down. USD down, gold up, USD up, GBP USD up. The analogy: USD is like the weighting scale. Gold and forex pair sit on one side. When USD goes up, they go down. It's physics. Key fact: 90% of the global forex transaction involve the USD. You cannot trade gold or USD without understanding dollar direction. Key concept: USD is strong, gold falls, USD falls, JPY USD falls. USD weak, gold rise, USD rise, commodities rise. DXY index: measure USD against 6 major currency, your North Star. First question: every session is dollar strong or weak today? Okay, that's good. Test. Okay, this is quizzes. DXY rises sharply. What most likely happened to gold? Gold falls. Correct. Gold is priced in USD. A stronger dollar makes gold more expensive for foreign buyers. Demand drops, price falls, and inverse correction. Let's go to next. News. News doesn't just move the market, it creates the volatility that haunts liquidity first, then moves in the real direction. CPI, known as inflation, plus NFP, known as jobs, and plus FOMC, known as the rates, and volatility, known as the direction. The analogy: news is like pouring petrol on a fire that's already lit. The direction was already decided. News just accelerate it. Like we know for the fact that market has already set its direction where it wants to move. But what does news do? News can go very fast in opposite way to haunt those liquidity and go to real direction, or it can just go to real direction super fast, rather than going slowly. Key fact: in the 60 seconds after NFP or CPI, the market can move 50 to 200 pips. The most retail trader get stopped out in that spike. Like, swear to God, like most retail trader we trade based on short, like a scalp trading for a few minute candle or 5 minute, 10 minute candle. Some big retail trader, they trade for days, but they have like big capital. Most small retail trader, like there is one up spike and another down spike, the whole account is blown. Most of the time this happened to me also. Key concept: CPI inflation higher than expected, USD strength, and gold drops. NFP jobs, strong jobs data, USD strength, risk assets drop. FOMC rates hike, USD strength, rate cut, USD weakens. The trap: price often moves opposite first, hunting liquidity then reserve. Here we have quiz. CPI comes in much higher than expected. What is the likely chain reaction? When CPI comes highs, yeah, this one. USD strengthens and gold falls. Higher inflation, Fed more likely to raise curves, USD more attractive and stronger, gold priced in USD becomes more expensive globally and falls. And macros. Fear is a force. When the world is uncertain, money moves to safety. As a trader, you must know where safety is. Safe haven asset. First, we got gold known as Chow USD, and we got dollar USD, and we got JPY known as the Japanese yen, and we got CHF known as the Swiss franc. And risk asset, we got stocks, crypto, out or NSD. The analogy: think of gold and USD like a bomb shelter. When bomb drops, war, crisis, political chaos, everyone runs there. Key fact: during the 2020 COVID crash, gold hit all-time high. During the 2022 Russian-Ukraine war, gold spiked $200 in days. Key concept: safe haven, gold, USD, JPY, Swiss franc, money flows here in fear. So basically it's saying whenever there is like big war or whatever big thing happening, money rather than going in the company or stock market or crypto, it moves out of those sectors and goes into the safe haven asset known as gold, USD, JPY or Swiss franc. Up to now, no cryptocurrency has been known as a safe haven asset, but it has been known as good asset in long term history. For example, crypto, Bitcoin, you got Bitcoin is good, known as the a gold of internet, but it more right now we saw like big people, big institution are all buying gold, and their single information and news can make gold crash, like Bitcoin crash and up. That's crazy, like Bitcoin is losing its purpose right now. Risk asset: stocks, crypto, high yield currencies sold in fear. Geopolitical risk: war, sanction, election, volatility, and opportunity. Sentimental shift: watch news headline, they tell you where fear is. A major war breakouts between two large economic. What is most likely to happen? Like this is the one: gold spikes and USD strength and stock fall because people lose fear. People will have the FOMO fear. And you know what the intelligent people do? They will wait for the stock market to fall, and when everything is at the low, they buy in the low, they buy in the cheap. And when the war goes off and there is no more war, people start to pour money again in stock, and these rich people get richer, by this kind of move. They already know if there will be war, and now they put their money in the war. All the people will enter, they take their money out from stock and they put in the war, they win money. And when they already maxed out their portfolio in the safe haven exit, they sell and they move on to stock. Uncertainty drives capital into safe haven. Gold and USD are the classified to safety asset. Stocks and risks asset get sold. system. You are not a trader who reads one chart. You are a detective who reads the entire market ecosystem before making a move. DXY check, news check, liquidity check, correlation check. And they after all this confirmation and your setup confirmation, enter a trade. And by the way, put risks to management always and your rules. Like if you lose one trade, you can only trade maximum of two trades a day. And if you lose one trade, that means those both trade that you took, you will not take trade anymore, and you will take note of the trade that you did each day. The analogy: a chess grandmaster doesn't just see the price they are moving. They see the whole board 5 moves ahead. That's. Key fact: every winning trade has at least three confluence: liquidity, USD direction, and a confirmed correlation. Never trade with just one. So we got here all these plus your setup, basically your edge against the market. That's it, guys. Key concept: step 1, check DXY, is dollar strong or weak? Step 2, check the calendar, is high impact news today? Check 3, find liquidity, where are the stops on the chart? Step 4, check gold silver correlation, do they agree? Step 5, enter only when 3 plus factors align. Test yourself. You see equal lows on gold, DXY is falling, and NFP is weak. What do you do? Like, you see equal lows on gold, DXY is falling, and NFP is weak. What do you do? Long, long gold. Like, rather than going for the lows of those equal lows, that we know that those equal lows will be swept and reversed fast. Equal lows, liquidity sweep likely downward first, then reversal up, DXY falling, gold should rise. Which weak NFP, USD weakens further, or three align bullish, high confluence, long setup. Guys, that's for today. Guys, that for today we learned good amount of knowledge about liquidity stops, USD strength versus weakness, news, CPI, NFP, interest rate, global events, war uncertainty, correlation. That's for today, guys. See you guys on day 19. Okay, bye.